Good afternoon, sir.
Hello, sir. Vanakkam. Good afternoon to you.
Good afternoon, sir. So we'll wait for another few minutes, sir.
No issue.
Yeah.
No issues at all. I'm all ready.
Ma'am, Dr. Shivashankari, ma'am.
A happy afternoon to one and all present here. It gives me immense pleasure to invite you all for this FDP. On behalf of SA College of Arts and Science, I invite Mr. Ravinder Singh Chawla founder and managing partner, RSC Skill Building and Consulting Solutions, LLP, whose presence makes the entire program glorious for all the 7 days FDP, including today's session. He is a man who is able to motivate the micro generation and also millennials by his unbeatable skills. The world is full of diamonds and gems, and we have one of those here to build our skill. With this note, I would like to give my heartiest welcome to our resource person, management, principal, and all the heads of various departments, faculty members, and all the participants from different prestigious colleges across India for the FDP conducted by our institution. Now, I forward the session to you, sir. The session is yours.
Thank you so much, madam, for your kind words of appreciation. Good afternoon to you and everyone. Today we are meeting probably for the last time in this FDP. So I would definitely try to make sure that you find this session useful to you. So let me share the presentation and then we'll start. All right, so I hope you can see the presentation. So we are today, going to be carrying forward what we were learning yesterday, and this will be part 2 of creating wealth with mutual funds. Now, let me first of all share with you the scores of the quiz, the cumulative scores of the first 23 or top 23 rankers. So as you could see, Dr. Pandurangan is topping the charts, and he has scored full marks till now for all these 6 days that we have had the online session for. Sir, heartiest congratulations to you. Great to have you with us. Heartiest congratulations to you. 30 on 30. Mr. Susidharan has also been, topping, but yesterday, he scored, so his score is 29 now. And you could see the scores of other people also. Heartiest congratulations to you. So we'll have another quiz today, and the results shall be shared, the toppers' results shall be shared tomorrow, by evening tomorrow. Okay. So let's go through what is it that we shall be learning about today. So today's session is going to be very, very important. We are going to be learning a lot of things from a practical point of view. And I'm quite hopeful that you will find today's session to be useful to you. So we'll first learn about the types of risks which are there in mutual funds and how to evaluate those risks, right? Because as investors, we would want to make sure that we are able to assess the risks and focus on the risk-reward ratio. So how to compare the risk-adjusted returns. And we'll also learn about direct versus the regular plans. And something very important, we shall learn about the SIP, STP, and the SWP processes. And that's what is scheduled for today's session. During this session, we will see a video also. And we'll also go to moneycontrol.com to actually see how does the comparison, how can we look at the risks and compare amongst different mutual fund plans. So the whole objective is to create wealth, to accumulate wealth for ourselves. Now, just to summarize, the mutual fund products are of different categories, right? So broadly speaking, there are 5 categories. We have various types of equity mutual funds. We have various types of debt mutual funds. We have various types of hybrid schemes. If you recall, we learned that hybrid is a combination of 2 or more asset classes, right? In fact, some of the hybrid schemes, they have combination of equity, debt, and foreign investments in foreign companies also. right? So in case you want to also invest in some companies abroad, you can also look at some of those schemes. Solution oriented schemes, as we learned, retirement and children's fund. And then we have other schemes also, which are index schemes or ETF and fund of funds. Now, hybrid, as the name suggests, it's a combination of, two or more asset classes. The whole objective is to, sort of allocate the risk, right? Because if you were to go purely for equity schemes, then you also need to, in terms of your asset allocation ratio, need to go for another debt scheme. So hybrid schemes allow you the facility whereby you can automatically do a risk, an asset allocation as well, right? So they have built-in allocation across two or more asset classes. Now, just to revise our learnings again, in case of debt funds, we have various types of schemes which are there, right? We shall also learn a little bit more about this today. So, depending upon how much, how long do you want to invest, you can appropriately map your horizon with the appropriate scheme. So just like as we discussed, in case you want to travel from Mumbai to Chennai, then you will sit in the flight which is going from Mumbai to Chennai. But if you want to travel from Mumbai to Delhi, then you will have to board another flight. Similarly, you need to match your goal, your destination in terms of the duration, or rather the maturity, with the appropriate fund. Again, a repetition, because this concept is very important, right? So it's all about risks, returns, and liquidity, right? We need to make sure that we understand what we are investing, keeping risks in mind. We need to focus on the kind of scheme considering the returns we want. Because if you want, let's say, returns which are 12%, 13%, then you cannot invest in a particular option. Let's say a debt option, which is going to give you 5%, 6% return, right? Let's say the money market fund, right? So obviously you will need to take a higher risk there. So generally, if you want higher returns, you will have to take higher risk. But if you think that no, I don't want higher risk, then in that case, you will have to focus on, or let's say you will have to be ready with getting lesser rate of returns, right? Similarly, liquidity is very important because like for example, yesterday somebody was asking, what if I invest in a gold fund, a sovereign gold bond, and I need money early, right? So if we think that we might need money before 8 years, then we should only invest the kind of amount which we may not require before 8 years, right? So asset allocation again is very important. So we should not put all eggs in one basket. We should allocate the risks, right? So the total risk reduces when we allocate the risk. For example, let's say you are traveling in a train and you have huge amount of cash with you. Just imagine, right? Then would you want to just keep your cash in one bag? No, it's more risky, no? So what you will do is you will allocate that cash across different bags. Maybe if you have family members with you, you will give some amount to one particular family member, right? Maybe you will, in each family member, with every family member, you will ask them to put that cash across various kinds of bags, right? So you are trying to allocate the risks. So this asset allocation concept is very important. Now, every investor would have different risk appetite. So what suits me may not suit you. What would suit person A may not suit person B, right? So just like in cricket, a batsman would score runs of every ball in a different manner, right? Because every ball may be different. You cannot hit the same stroke of every ball. Same is the case with investments. So we need to understand what is our risk appetite, right? So accordingly, we may create a portfolio. Again, SEBI has made our job easier because we have a riskometer, right? So every scheme, especially in case of equities, it's very important that we first we also look at the riskometer. That would give us an idea as to how much is the risk which the scheme carries, right? Across 6 levels that you can see, you will get some idea about it, right? Okay, so we did discuss it yesterday. Just a recap of various kinds of schemes and the kind of risk reward trade-offs which it has. So as you could see, the large cap funds would have amongst these ones which are shown, the large cap ones would have the least amount of risk. We are talking about equity schemes, so hybrid schemes are not there here, right? Yes, there are certain hybrid schemes where debt component is also there, so that will be different thing. But here we are talking about pure equity. So amongst equity schemes, the large caps would have the least risk. Why? Because these are large companies, these are established companies, right? They have been in business for a long time now. These are dependable companies. They have a huge brand reputation, right? They have a huge market share. So the risks are limited here. Yes, we may have some volatility in the short run or medium run, but when you are investing from a long-term perspective and you are investing regularly, right, the risk would taper off and you would get good returns from a long-term perspective. In debt schemes, again, we have risk hierarchy, right? So overnight fund, liquid fund, where the money is going to be invested only from the perspective of few days or few weeks, and that too mostly in government securities, as we will see in the next slide, right? The risk level would be lower. But then, let's say if money is being invested in those schemes where the credit risk is higher, right? The corporate bond schemes or the credit risk schemes, there the risk would be higher. In gilt funds or government securities, there is no credit risk, but here we have the interest rate risk. Because if the interest rates change, the price would get impacted. If the interest rates increase, the price would reduce. And today we shall spend some time on this particular thing. So let's look at the risk reward return across both equity and debt. Equity hybrid is also there, right? So across virtually different kinds of funds. Okay, so this is debt. And as you could see, in case of would have those schemes where the debt component would be higher and equity component would be lower. Okay, am I audible? I got this message that my internet connection is little feeble. Am I audible, please? If you could just text me. Am I audible? Can you hear me? Okay, thank you. Thank you. Right? So in hybrid schemes where the debt component is higher, right? But there would be still some equity component. So amongst the debt schemes, there the risk would be higher. That's the reason those are on the higher side, right? But if you look at purely debt funds, then the gilt funds or government bonds and corporate bonds, long-term corporate bonds and government bonds would have higher risk because of interest rate changes. Right? Similarly, in equity, as we've discussed, so this equity savings fund and equity-oriented hybrid funds are the ones which are hybrid funds. So there is also some debt element in it, right? In fact, in equity savings fund, the debt element is much more. Equity component is lesser. That's why they figure lower on this. But those schemes which would have only equity, there the risk would be higher. All right. So now let's again, although we did check out this slide yesterday, we've seen this few minutes earlier also. Let's revisit this, right? So which means that you need to keep in mind what is the horizon of investment, right? For example, if you are building an emergency corpus for yourself, right? Emergency corpus means you should have a kitty which should be at least 6 months of your equal to 6 months of your monthly expenses. Okay, let's take an example. Let us say your monthly expenses per month is 50,000. Right? Your monthly expenses 50,000 per month. Example, which means you must have a corpus of 300 lakhs. Okay. Now, where can you put this money? You should have this money preferably in a combination of fixed deposit and liquid schemes of mutual fund. Right? This one, liquid fund. Right? And so FD is not as tax efficient. So I would recommend more of liquid fund. So this would be from an emergency fund perspective. But let's say if you want to, remember in the first session, we said that your goals would be in 3 buckets: short-term goals, medium-term goals, and long-term goals. Short-term goals are the ones which are from 0 to 3 years perspective, right? So for all your those kind of goals, it could be some, holiday trip. It could be maybe you want to buy some gadgets, washing machine, or some appliances at home, or maybe there is a marriage coming in the family where you want to, spend some money on clothes, etc. So over the next 3 years, those kind of financial goals, short-term ones. So there you can park your money in this particular thing, ultra short duration fund or low duration fund or money market funds. Right? The risk would be the least. Right? You may get only, let's say, 4.5%, 5% returns, but then here safety is more important. Returns are not very important, right? Because you need liquidity also. You will need money within 3 years. So how do these schemes differ? Right? Remember in the first session what we said, that primarily in the debt funds, the risks associated are related to credit risk and the interest rate risk. Right? Credit risk means that the mutual fund company would have lent money to someone, a particular company, and that company is now not able to pay back the money, pay back the principal money. So that's default risk or credit risk, right? Now look at, these are the hierarchy that we learned about. This is the hierarchy that we learned about, right? So overnight fund, overnight fund, I'm sorry, the money is invested virtually in cash or cash equivalent securities, because these are against government securities, so they are as good as cash, right? Obviously the return would be very low, but the risk is also very low. In fact, it's negligible, right? Liquid fund, as you could see, there is little little bit of cash. Mostly it is money market securities, treasury bills, right? Mostly treasury bills of government, right? There is little component of sovereign securities, so government securities, right? And very little component of AAA rated securities. So again, here also, it's virtually maximum money which is absolutely safe, right? So the risk element here again would be only nominal. Money market fund, sorry, ultra short-term fund would have certain component of sub AAA rated securities. Sub AAA means below AAA. So primarily, let's say around 80% would be absolutely secure, very secure. 20% would have slightly higher credit risk, right? So on and so forth. Credit risk funds, as you could see, credit risk funds, as the name itself suggests, here the money would be invested, 65% money is below the highest rated security, which means below AAA rated one, 65% money. Only 35% is in AAA rated security, right? So this would suit those people who want to take high risks. Remember what we also learned, that if the risk is higher, if the credit rating is lower, the return would be higher, right? So if you want to take higher returns, you will have to take higher risk, right? So credit risk schemes would give higher rate of return, but the risk is also higher, right? Yield securities or government securities, as you see, they are almost all sovereign, investments in sovereign securities, government securities. So the risk here pertains, there is no credit risk. The risk here pertains to interest rate risks, right? Because these bonds are regularly traded. So when the interest rates are going down, at that time, these returns, these securities would give very high returns. So if the interest rates are likely to go down, then it makes sense to switch to government securities. But if you expect that interest rates are likely to go up, right? And as we learned, if interest rates go up, the prices will come down, then these securities may not give good returns, at least from a short to medium term perspective. Okay. So the risks in the debt markets primarily pertain to credit risk and interest rate risks. Credit risk, very clearly we know that somebody who has borrowed money is not returning the money. Interest rate risk, as we have learned, is pertaining to, because if the interest rates go down, then the demand for the previously issued securities carrying higher coupon rate would go up, right? The demand will increase, and so would their prices increase. But if the interest rates were to go up, then the demand for the existing bonds would go down. If the demand goes down, obviously the price will also come down, right? Which means the NAVs would also come down. So there, that's the interest rate risk which is there. Now, credit rating needs to be checked in terms of ensuring or let's say assessing what kind of credit risk would be there. Right? I gave you this example, if you recall, that in the northern part of the country, Delhi, Punjab, Haryana, etc., the landlords would prefer giving their house on rent to salaried employees, people who are in a salaried job, and that too people who are from other states, especially the southern states, right? Because they believe that people who are salaried ones, they are generally, they will not, try to occupy the house, or they will keep paying the rent on time, right? They may be willing to take a lesser rent also, as long as they feel that the risk is lesser. But if, let's say, some bachelor wants a property, right? Someone who's not married, then the risk would be higher. Those people may create some ruckus there, or there may be some other issues, right? Then the demand from the landlord for rent would also be very, very high. Okay? So if the credit rating is good, then the interest rate would be lesser. But if the credit rating is not good, then the interest rate would have to be higher. Then only you will be able to get money. So from a long-term perspective, as we will see later on, we will actually see the portfolio of certain debt funds, right? So you will see there AAA rated portfolio, AAA rated securities means the credit risk is minimum. AA rated plus would be next in level, and then single A, and then triple B, double B, etc., etc. Right? For a short term, let's say up to 1 year, there the rating would get classified with a numerical number. So 1 means highest safety, and if it is 1 plus, then this means absolutely high. Right? And then 2, 3, so on and so forth. So when you see a numeric digit against the rating, then you can understand that the maturity is for a below 1 year period. Right? Okay, just a revision. The impact of interest rate changes on the yield of bonds, right, or on the prices of bonds, sorry, right? So as we saw earlier, when the interest rates rise, the price of bonds go down, right? When the price goes down, the yield goes up. But when the price goes up, the yield goes down, right? So interest and yield would go simultaneously, but interest and price, they behave in a reverse manner, like a seesaw, right? So just like a seesaw, when one side goes up, the other comes down. When the other goes up, this one comes down. So that is what interest and price movement in case of bonds is. Which simply means that look at this scenario now. So now the interest rates have almost bottomed out. Just few days back, the Monetary Policy Committee of RBI did not raise the rates. So this may continue, the rates may continue till around Diwali. But thereafter, around December positively, the interest rates are likely to go up, start going up. Because by that time, inflation might start moving up, and RBI will have to increase the interest rates. Those of you who teach economics would know about this more than me, right? So which means that now if you have to put your money in a debt stream from a long-term perspective, please choose a shorter duration. Which means please invest in a particular scheme where the maturities are up to 3 years. Do not invest from a long-term perspective in a debt fund, because if the interest rates, if they move up or start moving up, the prices of those long-term bonds will come down. Right? We will discuss it more when we actually practically look at it. Okay? So let's now learn about duration of a bond. Let me ask you a question. My question is, suppose, I borrow 1 lakh rupees from you. Right? I borrow 1 lakh rupees from you. Now, you say that, okay, Ravinder, you can take this money, but I will charge you 8% interest. Right? And you say that I want interest to be paid to me on a quarterly basis. Okay? So let's assume, for the sake of simplicity, I am not talking about effective rate of return right now. Right? I am not talking about that. Let's take a very simple example. That 8% interest rate is what I am supposed to pay you, right? And you say that I want you to, you tell me that you want that I should pay you interest on a quarterly basis, right? So on a yearly basis, I'm supposed to pay you 8,000 rupees because the interest rate is 8%, right? But what I do is, what is it that what you insist is that every quarter, right? Let's say April, July, October, and January, right? Every quarter, I pay you 2,000 rupees. Right? This is situation number 1. The other situation is that I pay you every year interest, right? So I pay you 8,000 rupees at the end of year 1. I pay you 8,000 rupees at the end of year 2. Right? Now you tell me, in which case would your risk be lower? Would your risk be lower as someone who has lent money? Would your risk be lower in this case? Let's call it A, right? Option A, will your risk be lower? Or will your risk be lower in case of option B? Please write in the chat box. From your perspective, option A, the risk will be lower. Absolutely right, sir. You are right. Why? Because see, you are continuously getting some cash flows, right? Now, even if I were to default, let's say, at least you have got some money, right? The more you keep getting cash flows, you would continuously keep getting some amount from your principal back, right? Which means if I'm paying 2,000 rupees every year, 8,000 rupees you would have got at the end of the year, right? Which means over a period of time, considering the interest that you would be earning on that 8,000 rupees, if you were to invest it 2,000 rupees every quarter, right? You would definitely be recovering your money better, faster, right? That is exactly what duration is all about. In a simple language, in a very simple language, I am not getting into a technical language, right? So very simply speaking, longer the maturity of a bond, the longer is the maturity of a bond, let's say 10 years, 15 years, 30 years, right? the interest rate changes will be impacting the bond more. Shorter the maturity of a bond, the interest rate changes will have very little impact. Right? Again, another example. Let's say you are going on a car and let's say you're traveling from Mumbai to Chennai. Now that's a long journey, right? The risk will be higher. But suppose you were traveling from Chennai to Bangalore. It's a shorter journey. The risk will be lower, right? The probability of you facing some hiccups would be lesser, right? So just understand this one. Longer the duration of the bond, right? Higher would be the interest rate risk. We shall understand it with a practical example. Now, this we are talking about Macaulay's duration. It's called as Macaulay's duration. So every bond scheme will mention what is its Macaulay's duration, right? Which means, let's say there are two bonds. One is bond A, and the one is bond B, right? Let's say the duration of this bond is 5 years and the duration of this bond is 8 years, right? Which bond will have more interest rate risk? Obviously, bond B will have a higher interest rate risk because the duration is bigger, right? Now, this will become more clear when we go to the next slide. Now, the other thing is called as modified duration. Now, what does modified duration mean? Sorry, I should have. It seems I missed out animating this screen. Every slide is animated. It seems I missed out on this one. Apologies. That's the reason you are seeing the entire content on one screen. Sorry for that. So very simply speaking, modified duration helps you know as to how much would be the expected changes in the price of the bond if the interest rates change. Right? Example, assuming that the interest rates go up by 1%, right? Then obviously the price of bonds will come down. So if the modified duration of the bond is 4%, and if the interest rates change by 1%, the price would reduce by 4%. Okay? Let me explain it. So let's say if the modified duration of a bond is 4, and if the interest rates go up by 1%, if interest rates go up, the price of bond will come down, right? How much will it come down? Most likely would be basis, you can know about it, basis the modified duration of the bond. So if the interest rates go up by 1%, if the modified duration of the bond is 4, you can anticipate that the price of the bond will go down by 4%. Right? If the modified duration of the bond is 8, or let's say it is 4 only. Let's say if it is 4 only. If the modified duration of the bond is 4, and if the interest rates go up by 2%, how much will the price of the bond come down by? If the interest rates go up by 2%, and if the modified duration of the bond is 4, how much would the price come down by? Most likely 8%, right? It's the interest rate change, percentage interest rate change multiplied by the modified duration, right? So if modified duration is 4 and interest rates change by 2%, right? Then the price will come down by 8%, right? Theoretically speaking, if the modified duration is 4, if the interest rates go up by 0.5%, then the price of the bond will come down by 2%. 4 multiplied by half. Right? I hope it stands clarified. Thank you. So let's do one thing. Let us check out what is this modified duration? How does it really work? Right? By actually going to moneycontrol.com and checking out some of the portfolios of bonds. You will also see the credit risk there, right? So just a minute, give me a minute, please. Okay, so I'm connecting you to this thing, just a minute. All right, so I'm connecting to moneycontrol.com. Okay. So we go to mutual funds and we go to performance tracker of mutual funds. Now we go to debt scheme. And in debt scheme, we go to low duration fund. Just to explain, just to understand. Now let us check out this let's go to Axis Treasury Advantage Fund. Okay. Axis Treasury Advantage Fund. It's a low duration fund. Now you see that this scheme has given 4.79% returns as compared to the index, which is CRISIL 10-year government bond, right? So 10-year government bond is given, CRISIL 10-year government bond has given 2.47% return, whereas the scheme has given, higher than that, right? All right. Now let us check out say this modified duration of the bond is 0.71 years, which is 0.7, right? So it's low. Now, which means that if the interest rates were to go up by 1%, the price of the bond will come down by 0.7%. Right? Which means assume there are two bonds which you are comparing. The modified duration of this bond is 0.71, whereas the modified duration of another bond is 0.8, right? Which of them will be more riskier from interest rate risk perspective? The other bond, right? Which has modified duration of 0.8. Okay, so do check out the this duration thing positive. Okay, now just check out the yield to maturity of the bond. So yield to maturity means that assuming you keep holding on to this bond, you do not sell it, you keep holding on to it for, let's say, it's going to be for a period of 3 years, you hold it for 3 years, for example, right? Or let's say from a 3 years perspective, the return that you will get would be 4.3%. Right? That's the yield to maturity, which is right. How many securities it has in the portfolio? It has 145 securities in the portfolio. Right? Now check out the portfolio of the scheme. Remember, we said mutual fund schemes are very transparent. So they disclose their portfolio so you can check it out. See, Government of India bonds is 11.51%. The certificate of deposits is 6%. Treasury bills is higher, 22%. Commercial papers is 16%. Right? Commercial papers are issued by corporates, as we discussed, less than 1 year period. Right? So all this is less than 1 year period. So this bond will be appropriate from a 1 year perspective. Right? That is what the bond duration also is about. So keep the bond duration in mind. Right? So this one will be better from a 1 year perspective. Treasury advantages from a 1 year perspective. Okay. Government. So now look at so we check out the portfolio. Okay, so you go to portfolio now. We are checking inside the portfolio. Here we will see the credit rating. Right? Remember we learned about credit rating AAA, AA, right? And if it is up to 1 year period, you will see 1, 2, 3, right? 1 is most secure. So here you will see once more, right? Because it's a short period one. So as you could see here, these are treasury bills, right? So these have no credit risk which are there. See here. So A1, B1, these are all absolutely highest level security. AAA, right? AAA, AAA, P1, less than 1 year, P1. This one is slightly relatively next to AAA, right? But again, this belongs to Mahindra company, right? AAA, P1, right? So this is very clearly showing you the credit rating also. So you can take informed decision. You can actually, before investing, you can find out as to what kind of portfolio it has, right? Let's check out one more fund. So let's check out for a minute a long duration fund, right? So now let us check out yield fund. Okay, government securities, a long-term government security. Okay, so let's check out SBI Magnum Gilt Fund, government securities fund from a 10 years perspective, right? 10 years plus perspective. So let's check out first of all, the performance. So yes, this scheme has also given good returns beyond the index. So the returns are more than index, right? Again, let us check out the duration here. What's the duration? So modified duration is 1.95. So 2, almost 2. Right? Which means if the interest rates rise by 1%, the price will reduce by 2%. Right? So still, in considering that it's a long-term fund, the duration is lesser. So it's good. See, that's what I'll talk about later on. How important role does a fund manager play? Right? So the fund manager would have deliberately invested money in those securities where the maturity is lesser, which means the fund manager would have lent money for 2-3 years, that kind of period only. That's the reason the duration is lesser. If the portfolio comprises of those kind of papers where the maturity is longer, the duration would also be long. And longer the duration, considering the interest rates are likely to go up, the risk is higher. Right? So let's check out another scheme. So we go to guild fund again. Okay. Or let's now check out any corporate bond fund for a change. So let's check out corporate bond fund. Okay. So let's check out ICICI Potential Corporate Bond Fund. Just to check it out. Okay. So this performance of this fund has also been very good, higher than the benchmark. Okay, so this is good. All right, you go down. You say the modified duration. So where is modified duration? Yeah, 2.6 years, 0.6 years, right? So it's slightly higher than the previous one that we saw, but still, see, that's what fund managers are doing now because they know that interest rates are likely to go up. They have deliberately kept the duration low, so they are doing a good job. That's the advantage of investing through mutual funds because the fund manager would do the investing himself, right? We would not know what would be the right thing for us. So we rely on the fund manager to do that for us. Okay, great. So just to share with you the portfolio. So let's go to portfolio. Okay, so here the government securities is 26%. Treasury bills they don't have. Non-convertible debentures and bonds is the highest, 70%, because it's a corporate bond scheme, right? Now look at the rating. So mostly it is AAA rated one. So credit risk will not be there. Yeah, see, mostly it is AAA rated. Right? You're not seeing A1, A2 here because it's a long-term fund. It's not a 1 year or below maturity fund, right? That's the reason you're not seeing the credit rating with numeric number, right? But you see, it's all AAA rated one. It's most virtually everything is AAA rated one, which means should you be investing money in this? Yeah, I mean it's all good, nothing wrong with that, right? See, this is what informed. This is what awareness can do. You can take informed decision. Right. Another thing which we will see later on is the expense ratio. Okay. Yield to maturity, if you hold on to this scheme, right? What's the yield to maturity currently? It's 5.13%. So you will get around 5% returns. Right? So it's secure. I mean, the risks are not there, and you will get around 5% return. Okay. How much is the expense ratio of the scheme? Let's check that out. I think it's around 0.27 something. A riskometer, the risk level is moderate. Moderate. Why moderate? Because here there would be slightly some credit risk, theoretically speaking, although they have chosen not to lend money to those companies where the credit rating will not be good. But still, theoretically, there is some credit risk. And there would be interest rate risk also. But the fund manager has chosen to have lower duration, right? So the impact will be limited. For example, if the modified duration is 2, which means interest rates change, if it is 1%, then the price would come down by 2%. Modified duration multiplied by interest rate change. But if let's say the interest rate comes down by 1%, then the price will move by 2%. Right? So remember, the price changes. Simple formula is multiply the expected interest rate change by the modified duration. Simple maths, nothing. So if it is 1% and modified duration is 2, 2 into 1 is 2. Simple. Right? Okay, we will talk about. So this is the direct plan. We'll talk about it later on. Just bear in mind, this is the direct plan. The other one could have been regular plan. See this regular? the expense ratio will be higher in regular. We'll talk about it later on, right? So here the expense ratio is 0.27%. Expense ratio is what the mutual fund company will charge you. So if the yield to maturity in this scheme is 5%, as we saw, right? You deduct 0.27 from 5%. That is what is the net return you will get, right? Because the mutual fund is charging you 0.27%. They will keep deducting this from the NAV. So the net return to you will be net of the expense ratios. Okay. Now let's check out the regular scheme, the regular one. Here the expense ratio will be higher, as you will see now. Right? So just see. While it was 0.27, for the regular scheme, it is more than double. It's 0.58%. Right? You know why? Because this is the commission which gets paid to the distributor, the agent. Right? So agents will never give you direct plan. They will give you regular plan on. Right? And the expense ratio for regular plan will be higher. Because ultimately, who pays for the agents? It's only you and me who pay for the agent. Right? We'll talk more about it later. Okay. I hope you found this to be useful. Similarly, if you were to go to any equity scheme, yesterday we saw that, right? So while we'll be discussing it again, but since we are already here, let us also talk more about it. So let's go to performance tracker. Okay, let's go to small cap fund. Okay, small cap fund. And let us go to Kotak small cap fund. Okay, Kotak small cap fund. Now this is again a direct plan. Direct plan. What is the expense ratio? 0.5%, 0.52%. Right? What if we were to check it for direct, regular plan? Let's see. For a regular plan, it is 2%. See the difference. For a regular plan, this is 2%, almost 2%. 4 times. Right? Now, any scheme which does not have direct plan suffixed with it is a regular plan. Right? The expense ratios will be higher. Okay. So let's go back to direct plan. See the difference in the returns would also be higher in a direct plan. Okay. So here this riskometer is high. So the risk is high here. Okay. It's a 5-star rated scheme by CRISIL. Okay. So the scheme has given 108% returns, whereas the benchmark, which is small cap 100 total return index, the returns are 90%. So this scheme has given higher returns as compared to benchmark. Right? We are talking about a one year returns. Okay. Let's now analyze this further. And you see here that the standard deviation, we will learn about standard deviation later, right? Standard deviation tells you how predictable is the performance. Remember, I gave you the example of two class which you have. In one, the marks are consistent, whereas in the other one, the marks are not consistent. Right? So lower standard deviation would mean that the performance is more predictable. But if they are off the mark, right, too much, then the standard deviation would be higher. So lower the standard deviation, the better it is. Just bear in mind, lower the better standard deviation. Right? Beta tells you how volatile will it be. If the beta is higher, then this means the portfolio is expected to be more volatile. If the market goes up by 1%, this will go up by beyond 1%. At the same time, if the market goes down by 1%, this will slightly go down below that. The Sharpe ratio tells you how much are the returns considering the risk which the fund manager has taken or the risk which their portfolio is taking. Right? Higher the better. Higher the better. Remember, Sharpe ratio and trainer's ratio, higher the better. Standard deviation, lower the better. Right? Standard deviation, lower the better. Sharpe ratio and trainer ratio, higher the better. Right? Again, alpha, remember we discussed alpha yesterday. How much of excess return has the fund given as compared to the benchmark? So this has given 13% higher returns. Whereas the category average, the other funds in this category, they've given only 6 alpha. So it's a good fund. Right? And just to give a standard disclaimer here, I have my SIP in this fund. Okay, I must inform you that I'm also investing in this. All right, so let's go back. So I hope you've been able to understand this part. We will discuss theoretical portion again. Okay, one more thing. You also need to check out mutual fund fact sheet. Let me check that out. Let me open it for you. Just a minute. Okay, so I'm just connecting. Okay, so what you see on the screen is mutual fund fact sheet. Sorry. Yeah. So this is mutual fund fact sheet. You can download it. You can just Google it. You just say Axis Mutual Fund fact sheet. Right? Fact sheet. So this will give you complete information about various schemes of that fund. Right? So just to give you an example, let's go to the Treasury Advantage which we saw. So Treasury Advantage scheme, right? So what is the average maturity of the scheme? Now this is important, which means if you want to invest for around a year, 1 year, right? This is a good scheme because the average maturity of the papers they have is 1 year. So match your goal with the average maturity of the scheme. If you want to invest for 1 year, invest in a debt scheme which has average maturity of around a year. Right? If you want to invest for 3 years, invest in a scheme where the average maturity is around 3 years. Right? The risks would be lower. Okay. Now, what is the modified duration? Is 259. Right? So 259 days means around 0.7 years. So which means if the interest rates go up by 0.7%, 0.1%, sorry, 1%, the price would come down by 0.7%. Right? Okay. So what's the yield to maturity? It's 4.30. Right? Okay. Which is the benchmark? So it's mentioning about the benchmark. Who's the fund manager? How much experience he has? Blah blah blah. So there are 2 fund managers, and these are their experiences. Right? You can also get to see what are the other schemes they are managing. Okay? And this is the portfolio. Where has the fund invested money? As you could see, mostly it is AAA. So the credit risk is minimum. Right? So here you see commercial papers. So it is all numeric like we saw, and that too +1. So virtually the credit risk is very, very low. They have they have put their money in highly rated papers. Right? They also have sovereign bonds. Sovereign bonds, they do not have any credit risk. Right? So what all assets they have put money in, what all assets they hold, you can see everything. And you can check this out for every scheme. Every scheme. Okay? So this is the best way. Please make it a point. You will also be able to see the expense ratios. So let's go to expense ratios. All right. So see, they have put it somewhere. You can just search for it, right? You can get to know everything. Else, you can check it out from moneycontrol.com. Right? So that's the way you need to analyze and take informed decisions. See, because just look at it. If you have knowledge and you can invest it yourself, you would be able to save on the expense ratios. Right? All right. So let's go back to the presentation. Okay. Now let's talk about how can you invest money in mutual fund schemes. Right? So you can invest money in lump sum. And you can also invest money systematically, kunjam, right? So you can invest kunjam systematically. Pardon me if my pronunciation is incorrect. I'm just attempting to say something. Please don't mind it if I'm sure my pronunciation could be wrong. Okay? So you can invest systematically as well as lump sum. I would strongly recommend to you that in equities, please do not invest in lump sum. In equities, you should not invest in lump sum. Right? You should only invest in equities systematically. Okay. So how can you invest? There are various ways by which you can invest. We shall, systematically. Systematically, again, we shall learn about systematic withdrawal, systematic transfer. We shall learn about all these things. But let's quickly see a video on SIP. Give me a minute, please. Okay, so SIP in Tamil. Yeah. So I have already put it in the favorites so that I don't have to spend much time. So this is a video in Tamil. You may please see. I hope you can listen to the sound.
ரொம்ப சந்தோஷமா இருக்கு போல இருக்கு. அவ எஸ் சொல்லிட்டாளா?
இல்லன்னா ஸ்பான்சர்ஸ் எஸ் சொன்னாங்க. எங்க நிகழ்ச்சி அடுத்த வருஷம் முழுக்க பிரசன்ட் பண்ண சொன்னாங்க.
வாழ்த்துக்கள். இப்போ நீ இன்வெஸ்ட் பண்ண ஆரம்பிக்கலாம்.
இன்வெஸ்டிங் இப்ப பண்ண முடியாது சுப்பு அண்ணா. ஒரு அளவுக்கு பணத்தை நான் சேமிக்கிற வரைக்கும் அது முடியாது.
தப்பு.
Sorry, what has happened? Just a minute. Sorry.
இப்போ நீ இன்வெஸ்ட் பண்ண ஆரம்பிக்கலாம்.
இன்வெஸ்டிங் இப்ப பண்ண முடியாது சுப்பு அண்ணா. ஒரு அளவுக்கு பணத்தை நான் சேமிக்கிற வரைக்கும் அது முடியாது.
தப்பு. பணத்தை சேகரிக்க வரைக்கும் காத்துக்கிட்டு இருக்க வேண்டாம். மியூச்சுவல் ஃபண்ட்ஸ்ல உங்களுக்கு ஆப்ஷன் இருக்கு. SIP.
SIP?
ஆமா, எஸ்ஐபி. இது ஒரு ரெக்கரிங் டெபாசிட்னு நினைச்சுக்க. சிஸ்டமேட்டிக்கலி கொஞ்சம் கொஞ்சமா ஒரு குறிப்பிட்ட காலத்துக்கு.
இஎம்ஐ மாதிரி ஒவ்வொரு மாசமும் கொஞ்சம் கொஞ்சமாவா?
ஆமா, ஆனா இல்ல. ஆமா, ஏன்னா ஒரு குறிப்பிட்ட அமௌண்ட் ஒவ்வொரு மாசமும் உங்க பேங்க் அக்கவுண்ட்ல இருந்து டெபிட் ஆகிட்டே இருக்கும். இல்ல ஏன்னா இஎம்ஐ மாதிரி நீங்க பணத்தை கொடுக்கல, இன்வெஸ்ட் பண்ணிக்கிட்டு இருக்கீங்க. எதுக்காகனா இதுல பெட்டர் ரிட்டர்ன்ஸ் கிடைக்கிறதுக்காக. அப்புறம் ஒரு விஷயம், தேவைப்படும் போது உங்க பணத்தை நீங்க எடுத்துக்கலாம்.
வாவ், அதாவது மறந்து போயிடுவோங்கிற டென்ஷன் இல்ல. ஒரு தடவை பேங்க்குக்கு ஸ்டாண்டிங் இன்ஸ்ட்ரக்ஷன் கொடுத்துட்டா அது ஆட்டோமேட்டிக் ஆயிடும்.
அது மட்டும் இல்ல.
Okay, all right. Were you able to listen to the sound? No.
Yes, sir.
Play it
Yes,
again.
sir.
Okay. Thanks.
Yes, sir. Yes, sir.
All right. Right. So you can buy a lump sum also, but I would recommend that in case of equity, you must go for systematic transaction. So let's learn more about it. So what is SIP? So in SIP, you would be having money in your bank account, right? So from your bank account, the money will go to the scheme systematically. Right? Systematically, the money will go from your bank to the SIP, to the mutual funds, right? And your corpus would keep getting accumulated. That's SIP. Now let's assume that you get bonus from your office. Example, right? You get some lump sum money, maybe your parents gifted to you, or somehow you get some lump, maybe you would have sold some property, you get some lump sum money, right? Now what to do with that? What you can do is that you can put that money in a liquid fund, right? And from that fund, systematically, you keep transferring money to the equity fund. Systematically, right? Let's say you have 2 lakh rupees lump sum with you. So instead of putting all that money in equity at once, you systematically put 10,000 rupees every month over the next 20 months, right? This way, because there could be volatility in the market, you do not take higher risk, but you keep investing systematically. This is called a systematic transfer plan, right? Systematic transfer. So you are systematically transferring. It's like, for example, you see some patient in the hospital, right? And you see those IV fluid, the drip which is there, and drop by drop, it goes into the veins of the patient, right? This is what it is like. So if you have some lump sum money and you want to put it in equity, instead of putting it in lump sum, what you do is you put it in a liquid fund and systematically you start an STP. You give instructions to the mutual fund company to systematically transfer it into the equity scheme every month, right? So this way you would be able to get better returns. Now let's say you were investing money for your daughter's education, right? Your daughter is going abroad and she needs money regularly. You have to pay her fees, right? So what you can do is, instead of withdrawing all your money from the equity scheme, you withdraw it systematically. So every month you give instructions to the mutual fund company to transfer a certain amount of money to the bank, right? In that case, systematically, the money is going to go to your bank, right? So this is what SWP is about, systematic withdrawal plan. Okay, so we learned about systematic investments, SIP. We learned about systematic transfer, right? from liquid to equity scheme. And we also learned about systematic withdrawal from the equity scheme to your bank account on a regular basis. I hope this is clear. In case there's any question, please do let me know. Yeah. So this is what we were discussing, how to analyze the performance of a scheme. So one is against benchmark, which we saw, right? How good is the performance against the benchmark? Then comparing the risk-adjusted returns. So we saw about standard deviation. We learned about the Sharpe ratio, the Trainer's ratio, right? And we can also compare the performance with the peers. So again, on moneycontrol.com, you can see performance against the peers also, right? Plus, you can also see how competent is a fund manager. So from the fact sheet, you will get that information. You can also compare the expense ratios, right? Expense ratios of the scheme with that of the competitors. So performance against benchmark, as we discussed, you will get to know as to what is the alpha. We learned about beta also, right? Alpha is how much of extra return are you getting considering the benchmark returns, right? Remember yesterday we learned about active funds, right? Actively managed funds. So these funds would try to give higher returns as compared to the benchmark. So alpha will tell you how much is the excess return over the benchmark. So ultimately, it's all about risk versus reward, right? The more risk you take, the lesser will be the reward. The more focus you put on reward, you will have to take higher risk. So it's a trade-off which is there, right? So you would want to make sure that the return is higher for the given amount of risk which the scheme is taking, right? So the risk-adjusted returns get known by the standard deviation and the Sharpe and Trainer's ratio. Okay, so the funds which have a higher risk-reward ratio, that will be better. Okay, so we learned about beta, we learned about Sharpe ratio, we learned about Trainer's ratio, we learned about standard deviation. Let us check it out once again. So standard deviation is how consistent are the returns around the means. More the consistency, the better is predictable performance, isn't it? Beta is how much is going to be the volatility, right? So if let's say the portfolio has a low beta, it means it will be less volatile. But at the same time, it may also give a message that probably the fund manager is playing too safe, right? So you need to correlate it along with the other aspects, standard deviation, Sharpe ratio, etc. Right? Sharpe ratio, as we discussed, the higher it is, the better it is. That shows that the fund manager, how much return is the fund manager giving for the given risk which they are taking. Right? So higher the average Sharpe ratio, the better it is. Same with Trainer's ratio also. Right? Higher the better. Okay? Just remember that you have to check out standard deviation should be lower. So if there are two funds, one with a lesser standard deviation, that's a better one. The one which is giving higher Sharpe ratio is a better one. Higher Trainer's ratio, a better one. Right? Trainer's ratio, Sharpe ratio has to be higher. Standard deviation has to be lower. Simple. You can also compare the performance against the peers. So what are others doing? Like for example, in case of colleges also, the students would have been comparing, colleges against each other, right? I'm sure, many times India Today comes out with this rating report. They survey various colleges and they say which college has been the best one, right? So all these things are there. So mutual funds, you can compare the performance of a particular scheme with the other mutual funds. You can also compare the expense ratios. We saw expense ratios, right? A higher expense ratio would mean ultimately the return would get impacted. Okay, we have already discussed this. I gave you this explanation earlier. So direct plan means that there are no intermediaries involved, right? And ultimately, the commissions for the intermediaries goes from your and my pocket itself. So direct plans would have a lesser expense ratio. So any scheme which is a direct plan will have direct plan suffixed with it, right? Towards the end of the scheme, direct plan name would be written. Direct plan would be written. But if direct plan is not written, then it is not a direct plan. Just remember this, right? For example, distributors will never give you direct plans. And many times I have got to know from certain clients that the moment they tell the distributor that I want a direct plan, the distributor says, sir, this is direct plan only. And the client believes it. If the name does not get suffixed with a direct plan, it is not a direct plan. Simple. Right? Having said that, say, let's say you have cook in your house, right? Because everybody is working in your house. Obviously, you will need an outside resource. You would have been paying money to that cook, isn't it? You can cook the food yourself also, but you don't have time, right? So if you think that you can do, you can do this analysis, you can take an informed decision where to put your money, then fine, you can try and save money by going for direct plans. But if you think that no, you cannot do it, right, then it does make sense to hire the services of an advisor who can give you proper advice, right? Because it should not be that you take a wrong decision. But the whole objective of this particular learning program is to help you get an idea, and if you can use this knowledge and keep learning more also, because at the end of the day, as we know, knowledge is a bottomless ocean. The more we learn, the lesser it is, right? So if you can use this knowledge to take informed decisions and buy direct plans, you can save a lot of money. So the choice is yours. Okay. So you can invest directly or you can go through distributors, right? So you can also go to registered investment advisors, you can go to brokers. There are a lot of large chains which are there in financial services. They can also give it to you. You can buy it from banks also. Nowadays, there are a lot of online platforms also which are, you can buy through them also. Else you can directly go to mutual funds company's website and buy directly through them as well. Let's have now a case study. So this case study is about three friends, right? One of them is Rajnikant, other one is Vijay, and the third one is Madhavan. Okay, so these three friends, they are very close friends, and what they decide is that we will start investing money when we start our professional careers. So they are students, right? So what they decide is that we will start investing 1,000 rupees per month. And we will keep stepping up our investments by 10% every year, which means first year we will spend 1,000 per month. Next year we will enhance it by 10%, which means 1,100 per month. Then again we will enhance it by 10%, which means 12,210, and then 1,331 per month, so on and so forth. Right? So they say that we will keep, because our salaries will keep increasing, so we will keep enhancing our investments also by 10%. Right? Now, while Rajnikant starts investing from the age of 22, Vijay starts investing from the age of 25. And Madhavan starts investing from the age of 30. Right? Now they are supposed to retire at the age of 55, which means Rajnikant will invest for 33 years, right? Vijay for 30 years and Madhavan for 25 years. Okay? Assuming that they get rate of return at the rate of 12% every year, who do you think would have accumulated maximum money and why? Yeah, question for you, please. Yes, please. Kindly attempt. Who do you think would be accumulating maximum money and why? No answer? What happened? Yes, please. Kindly share, please. Okay, somebody has answered now. Okay, Rajnikant, as he invests for more years. Fantastic. Thank you, Yusuf sir. Thank you, Matilda madam. Perfectly right. Perfectly right. Right? So sooner we start, the better it is going to be. Right? Because as they said, the longer you invest, the more will be the corpus. Right? Do you want to see the difference? The difference is that Rajnikant would have accumulated 1.26 crores and Vijay would have accumulated just 83 lakhs. And Madhavan would have accumulated just 41 lakhs. Now look at the difference. Just compare the difference between the accumulation of Rajnikant and Vijay. Right? Although Vijay started investing just 3 years later on, Rajnikant's accumulation was 50% more than Vijay. Right? And Vijay's accumulation was 100% more as compared to Madhavan's. Although Madhavan started investing just 5 years later on. Right? So the sooner we start investing, the better would be the return, higher would be the returns. So kindly start investing aggressively, right, as much as you can, as early as possible, right? And please also encourage your students to start investing, because you know, if they delay it, just like the example which we have discussed, Rajnikant, Vijay and Madhavan, the longer they delay, the impact would be huge, right? So let's discuss learning. By the way, since you're talking about equity, in case you want to get a session on equity for the students and the virtual trading platform also, absolutely free of course, just 1 hour session. I'm sharing a Google form link with you here. You may, just let me know about the college name, right? College name and your mail ID. I can send a proposal. So this is what we wanted to cover today. So I wanted to complete it by 3:30 so that we could have question answer also. Plus today validity would also maybe take more time. So good thing we've been able to complete it by 3:30. So this is what we learned today, right? I'll be happy to answer any questions that you may have. Any questions, please? Okay, just a minute. Sorry. I missed 2 slides. Just a second. Sorry, I'm connecting again. I beg your pardon. Sorry. I hope you can see the presentation, right? Okay. So,
Yes, sir.
okay. So just to summarize what we have learned over the last 7 days. First session, we learned that you need to understand your financial goals. Okay. Secondly, remember the Trinity of Investments. It's always about risk, returns, and liquidity, right? Plus, every investor is different. So please do not blindly follow someone, right? You are different. I am different. Somebody else is different, right? So invest considering your risk appetite, your goals, your asset allocation ratio. Remember 3 buckets: short term, medium term, long term. Invest from that perspective. So for example, if you want to invest for short term goals up to 3 years, debt funds are the ones you should focus on, right? Medium term, 4 to 7 years, you can focus on hybrid funds, right? Combination of equity and debt, right? Long term, 7 years plus, right? More than 7 years, there you can focus, you can take more risk. So diversified fund across all cap, large cap, mid cap, small cap, right? You can go for your sectoral thematic funds also, right? You can take more risk, but only from a long term perspective. Do not invest in lump sum in equity and use STP, right? Otherwise, regularly use SIP. Mutual funds offer many options, right? You can invest across various kinds of securities. So the more you learn, the better it is. The Tamil video which I showed you is mutualfundssahihai.com website. They have a lot of information, right? You can refer to that website. You can refer to moneycontrol.com. You can refer to valueresearchonline.com. You can refer to fundsindia.com. Right? And by the way, yours truly is also available. I'll be happy to, answer any queries that you may have even after this session. See, relationship is for life. Friendship is for life, right? It's not just a matter of 1 session or 2 sessions. I am very passionate about, supporting whatever I know, spreading this knowledge to others. That's what my bread and butter is. I don't have anything else. I am 100% into it. And I'm very, very passionate about it. Okay? So if I could be of any help, please do count on me. Okay? Start as early as possible, as we. So what we covered in this FDP, we learned about introduction to financial planning. We learned about equity markets. We learned, learned about debt markets. We learned about AML provisions. And we also learned about creating wealth using mutual funds. Okay. So I'll be happy to answer any questions that you have.
Participants, if you have any question, you can unmute and you can talk.
Any question which might have got, which might have gone unanswered, or probably which you may have asked, but maybe I may have missed out answering, possible. Kindly, please feel free to ask. Yes, please. Any questions? No question.
I hope, sir, it was a
So-
crystal clear presentation. Sir. Thank you so much.
I always say this, that if there are no questions, then probably one option could be that everything went over the edge. Nothing was clear. Whatever Ravinder Singh Chawla you told us, nothing was clear to us. Nothing was understood. It could mean that. But since you are all professors, and it's been my privilege, you guys are so intelligent. You are full of knowledge yourself. I presume that you would have been able to understand. But still, if there is any doubt, kindly feel free. Sir, if you could, maybe I request you if you could, okay, yes, madam, sharing the quiz today. Yeah, so it's there in front of you. Sukanya Samriddhi Yojana, especially for girl child, you have. Madam, there is no specific scheme for the boy. You can invest through mutual funds. So we learned about different equity schemes. We also learned about children's fund. So you can invest money through any of these things, right? See, for all practical purposes, it's just a thought that I am investing for boy or a girl. Ultimately, the investment could be any good. It could be for the child, it could be for retirement, it could be for any good. So you can invest for anyone, right? To the best of my knowledge, there isn't any specific scheme for the male child. For the girl child, it's been so because unfortunately, as you know, in many states of us, female foeticide is being practiced in many families. It's not there in the southern part of the country, but in certain North Indian states, it's been very specific. Haryana, Punjab also, Rajasthan also, and that's an unfortunate part. So the government has been attempting to support people, or rather encourage people to start saving money for the girl child. So that was the focus behind. Madam, have you been able to answer your question? Welcome, ma'am. And by the way, this Sukanya Samriddhi, the rate of return which you get is just 7.1%. So that's not much. The advantage is that it's tax free, right? There are no the maturity, at the time of maturity, it is not taxable. But still, equity will give you far better returns, even if you look at it. So I would strongly recommend to you that you focus on your asset allocation ratio. If you say that 70% would be equity, then 70% would be equity, and balance could be 30% could be maybe debt and gold, whatever. By the way, how many of you invested in that sovereign gold bond scheme? And the website which I told you was not a correct one. My apologies for that. It is stockholding.com. Stockholding. Tenures for T-bills, madam, is 182 days, 91 days, 182 days, 364 days. So there are three kinds of maturity terms which are there. The auction, you also have 91 days T-bills, you also have 182 day T-bills, you also have 364 days T-bill. Normally it is, the most popular ones are the 182 days and 364 days. Welcome, madam. Okay, another suggestion to you all. See, what I would strongly suggest to you, that whatever amount you can invest, just bear that, just think about. So let's say you decide to invest 10,000 rupees per month, example, right? I would recommend to you that you set up SIPs in advance, so that the money gets debited from your bank account towards the start of the month itself, so that you are left with only the amount which you can then spend, right? So first save and then spend. That should be the approach, right? Because otherwise we will get tempted to blow off, to spend our money on multiple things. So some Amazon sale would be on, some Flipkart sale would be on. Our children may want some mobile phone, blah, 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 blah. I'm sure we all would have been grappling with this challenge, wherein our children keep demanding something or the other, right? But it's important that we first save or invest, and balance we should spend. Thank you so much. Thank you so much, sir. I would want to thank Principal Madam, Dr. Ganpati sir, and all the other respected faculty members of SA College for giving me this opportunity of offering my services. And thank you very much. Thank you so much, all the participants, all the esteemed faculty members, the participants, for being so patient and bearing with me. Really appreciate. You were very regular. You were all regularly taking up the quiz. Thank you so much. Looking forward to being in touch with you. This is my contact number. You may kindly save the number, so that because I'm sure you guys are so busy. So looking forward to be in touch with you for life. Thank you,
Thank you,
sir.
sir.
Thank you.
Thank you.
Thank you, sir, for sharing your immense knowledge. All these valuable insights gave us a new perspective that one should adopt while discussing issues on marketing, anti-money laundering, mutual funds, and etc. As William Author rightly said, feeling gratitude and not expressing it is like wrapping a present and not giving it. So to express our gratitude, I now request Dr. S. Ganapathy, Associate Professor, Head Department of Corporate Secretaryship, to propose vote of thanks.
So before you speak, can I make a request? Is it possible for the participants to, if possible, if you could just switch on your camera? I mean, we'll take a photograph. It would be something which I would cherish
Definitely.
always. If those of you who can, switch on, maybe somewhere everybody may not be able to do that. Thank you.
Participant kind requesting everyone to please enable your video.
Thank you. Really appreciate it. Thank you so much. Really appreciate it. Thank you so much. Thank you.
Very good evening to one and all present here. I'm Dr. Ganapati here to propose a vote of thanks for the 7 days FDP on cognitive analysis in financial services. We'd like to thank our speaker, Mr. Ravindra Singh Chawla, for enlightening us with his knowledge on financial services on different dimensions and perspectives. I hope the session was really full of like sharing knowledge and interesting information. It gave deep insights into the topic and also revealed many interesting facts and was a really highly informative session. I'm pretty sure that the precious knowledge given by our guest, Mr. Ravindra Singh Chawla, will definitely help us in our future financial research studies and future. Thank you very much, sir. And I will also thank our correspondent, Mr. Venkatesh Raja, sir, and our director, Dr. Sai Satyavati, ma'am, and our principal, Dr. Malati Selvakumar, ma'am, for permitting to organizing this 7 days FDP through webinar, through online. As you all know that organizing such an event is generally a result of close cooperation among several institutions and individuals. It's my great pleasure to express my gratitude and appreciate on behalf of SA College and my own behalf for the support and encouragement provided by all such individuals, the participants and the institutions for making this FDP a grand success. I wish to thank the organizing committee members, Mr. Tangakumaran sir, Dr. Shivashankari, Ms. Rajalakshmi, KB Priya ma'am, Dr. Sambasivam, Dr. Purushothaman sir, Dr. Tyagarajan, Dr. Kamaraj, and Ms. Irfan Mira, who really like worked hard to make this event a grand success. Thank you so much. With this note, I would like to thank you all once again. I'll meet you all in our upcoming programs. Thank you all. Thank you, sir.
Thank you so much. Good luck to all of you. Best wishes. Vanakkam.
Thank you. And the feedback and certification form will be rolled out tomorrow. Like since for the quiz, it will be closed by 6 p.m. today. So we need to consolidate the score. And on tomorrow, I think in the group, you will be getting the link for feedback and certification. So based on the scoring, your certificate, the grade will be determined. Thank you. Thank you, sir.
As Gordon B. Hinckley said, gratitude creates the most wonderful feeling. It can resolve disputes. It can strengthen friendships. It makes us better men and women. I thank you all for your patience and good cooperation during the session. Thank you.
Thank you, sir.
Thank you for